All right, let's dive right in. Today, we're going to talk about a totally different way to look at real estate investing. It's a philosophy that honestly could shift your entire perspective on money, on debt, and what it really means to build wealth. I want you to try and forget everything you've ever been told about your house being your biggest asset, because we're about to tear that idea down and build a new one from scratch.
So here's our game plan for today. We're going to start with a really basic choice every investor has to make. Then we'll get into the mindset shift. This is huge. It's about seeing money the way wealthy people do. After that, we'll uncover the secret power source they use to grow their wealth, and I'll lay out a simple blueprint for looking at any deal. We'll see how it all works with real estate, and then pull it all together so you can start building your own financial fortress.
Okay, let's get right to the heart of it. Before you even think about buying a property or a stock, you're standing at a fork in the road. Are you playing the game of hoping prices go up, or are you building a machine that pays you month in and month out? This one choice, well, it changes everything.
So I want to ask you something point blank. Are you an investor or are you a speculator? Now, you might immediately say, I'm an investor, but your actions might tell a different story. The real answer depends entirely on what you're actually trying to do with your money.
Let's break these two paths down. On one side, you've got capital gains. Think house flipping. The whole game is to buy low and then pray you can sell high. You're basically gambling. You're speculating that the market's going to go up. The big problem? You have absolutely zero control over the market. It's a high-risk, high-stress guessing game. But then there's cash flow investing. Here, selling is the last thing on your mind. The goal is to buy and hold things, assets, that put a steady, predictable stream of cash in your pocket every single month. See the difference? The speculator needs the market to go up to win. The cash flow investor wins every time a rent check clears, no matter what the market is doing.
Now, if you really want to get on board with cash flow investing, you've got to make a pretty major shift in your thinking. It all starts by challenging the most basic ideas about money that we're all taught as kids. This next concept, it's probably the single most important and maybe the most controversial thing we'll talk about today.
And there it is. That one little sentence from Robert Kiyosaki has probably started more arguments than anything else in personal finance. I mean, our parents, our bankers, our friends, they all tell us our home is our biggest asset. But if you followed the cash flow philosophy, that's just flat out wrong. And here's why.
Forget all those complicated definitions from accounting class. The rich have a much simpler rule. It's incredibly simple. An asset is anything that puts money in your pocket. A liability is anything that takes money out of your pocket. That's it. That's the whole game. The only thing that matters is which way the cash is flowing.
And this chart just makes it crystal clear. Look at a rental property. It's an asset. Why? Because your tenant pays you rent, and that rent covers the mortgage, the taxes, the insurance, and with any luck, there's money left over for you. Cash flows in. Now look at your own home. It is a liability. Every single month, money flows out for the mortgage, for taxes, for upkeep. And that's not even counting when the water heater breaks or the roof starts leaking. It doesn't pay you to live there. So you see, it's not about what something is. It's about what it does to your wallet.
Okay, so you're probably thinking, great, the goal is to buy assets that put money in my pocket, but I don't have $1 million lying around. And that is where the engine that drives this whole strategy comes in. It's about learning to see debt not as a burden, but as a powerful tool.
You know, we're pretty much programmed to think all debt is bad. But the wealthy know there's a huge difference. There's bad debt. That's the stuff most people are drowning in. Credit cards for TVs, loans for cars that lose value. You use it to buy liabilities, and you're the one stuck paying it back. It makes you poor. But then there's good debt. This is debt you use to buy an asset that makes you money. And here's the magic trick. With good debt, someone else pays it off for you.
This is the incredible power of leverage, what people call OPM, other people's money. It's actually pretty simple when you break it down. First, you come up with a small piece of the price, the down payment, maybe 20%. Then the bank brings the other 80%. So now you control 100% of a big asset, but with only 20% of your own cash. Step 3, you put a tenant in the property, and their rent check every month pays the bank's mortgage, the taxes, everything. And then the best part, whatever's left over at the end of the month, that's your profit. It goes right into your pocket. Your tenant is literally buying you an asset.
Let's just put some super simple numbers on this. Let's say you find a small property. You can rent it out for $1,000 a month. And let's say after you pay the mortgage, the taxes, insurance, and set aside some money for repairs, your total expenses are $700. Well, that leaves you with $300 of positive cash flow every single month. That's $300 in your pocket from an asset that the bank and your tenant are paying for. It comes in whether you're working, sleeping, or on a beach somewhere.
All right, so we get it. The goal is cash flow, and the engine is good debt. But how do you know if you're looking at a good deal or a total disaster? You need a system, right? A framework that stops you from just guessing and helps you make smart, calculated decisions.
This framework, the 4 pillars, is like a complete checklist for any investment. Think of it this way. Fundamentals are about the health of the thing you're buying. Is the property in a good area? Is it well maintained? Technicals are like the weather report for the market. Are prices going up or down? But for a real investor, the true power is in the last 2 pillars. Cash flow is your specific plan to make money from the asset, and risk management is your escape plan, how you protect yourself if everything goes sideways.
Now this slide, this is the whole ball game right here. Look at this list. The first 2 pillars, fundamentals and technicals, are mostly things you can't control. You can't control the national economy. You can't stop a market crash. You can't control interest rates. Speculators waste all their time and energy trying to predict this stuff. But look at the right side. The last 2 pillars, cash flow and risk management, are almost entirely within your control. You control your rental income strategy. You control your expenses. You control your insurance. A real investor focuses all their energy on the things they can actually control.
Okay, we've got the strategy down. So let's look at the mechanics, the nuts and bolts of how this actually plays out in the real world. This is where you really start to see how real investors create wealth using systems, not just by getting lucky.
Let's talk about a super important number, net operating income, or NOI. It's a simple formula. All the money a property brings in minus all the costs of running it. It's the pure profit of the building itself. Now, what's so powerful about this is that commercial properties are valued based on their NOI. That means you can actually force the property's value to go up. For example, if you add a laundry room, you've just increased your income, which raises the NOI and the property value. If you find a way to lower your water bill, you've decreased expenses, which also raises the NOI and the property value. It's called forced appreciation, and it's something you have direct control over.
Now, let's talk about one of the coolest tax advantages out there for real estate investors: depreciation. Basically, the government knows that buildings get old and wear out, so they let you take a tax deduction for that wear and tear every year. But here's the kicker. It's a non-cash expense. It's a loss you can claim on paper, but no actual money ever leaves your bank account.
And this is where the magic really happens. When you take your real cash flow, that $300 a month from our example, and you combine it with this paper loss from depreciation, well, that paper loss can wipe out your real income on your tax return, legally reducing your tax bill often to zero. This creates something called phantom income. It's real, actual cash in your pocket, but as far as the tax man is concerned, it doesn't exist. It's a huge reason why real estate is such a powerful wealth-building tool.
Okay, so we've talked about the mindset, the tools, the nuts and bolts. Let's wrap this all up by looking at the ultimate goal here. We're not just trying to own a rental property or two. We're trying to build a resilient, income-generating business, a financial fortress that can handle any economic storm that comes its way.
This quote from tax expert Tom Wheelwright just nails it. This isn't a hobby. It's not a get-rich-quick thing. If you want to succeed in the long run, you have to treat this like a real business, with systems, with strategies, and with a professional mindset.
And this is what that business looks like. It's a fortress. It's built on a solid foundation of assets that pay you every month. The amazing part about this fortress is how strong it is. So what if the housing market crashes and your property values drop on paper? It doesn't matter. As long as your tenants are still paying rent, your cash flow keeps coming in. Your fortress is powered by good debt, it's protected by smart risk management, and it's supercharged with tax strategies like depreciation. This is what leads to real financial freedom, an income stream that has nothing to do with your job or with a volatile stock market you can't control.
We've gone over a ton of stuff today, from completely redefining what an asset is to using good debt to building an entire business. But this is just the beginning of your financial education. It's not the end. The ideas are simple, but putting them into action takes learning and, well, action. So the last question isn't for me to answer. It's for you. Now that you've seen the blueprint, what's your first move going to be?